Welcome back to those at home as well. And we're starting off with the underpinnings of the financial market integration. I gave the word to Sebastian Heidebrecht, not Heidbreder. Sometimes they call me Heidebrecht. So, but now the floor is yours. Thanks.
Okay, thanks very much for having me, for presenting the paper From Financial Fix to Digital Fix. I've basically 3 disclaimers to make. The first is we changed the title. The second one is, so what we try to do in the paper is look less at capital markets union per se and capital market security, etc., but to look into the, on one hand, infrastructural underpinnings, so what is required to make this going, and third, to really focus on households, on their savings that should be mobilized, so less on capital markets per se, but really on the direction and what changed with the Savings and Investment Union, at least in our perspective. So let me start with the puzzle. Basically, the question was, okay, why deepen financial integration after the financial crisis and after the crisis of financialization more generally? And here the argument in Critical Political Economy, for example, also in a special issue from 2018 in the Journal of Competition and Change, was that, well, the capital markets union per se is already quite puzzling because there was the financial crisis. And then the question is, of course, okay, why then do European policymakers still, use capital markets as a solution to that problem? And in Critical Political Economy, the argument, and then we build even on that and ask, okay, if this is a problem, why even then your policymakers get one step forward and even financialize savings and investments of households, not only of companies. So the puzzle is basically after the financial crisis, one might expect a retreat from market-based finance, yet European policymakers double down on it and now explicitly even target household savings. So the key question is, what does explain this doubling down on financial integration and what has changed? And our core idea is here to argue that it's not just a retreat from financialization, but it's a reorganization of that. And our argument is that the existing explanation is what I just referred to, the Gabor and Brown special issue, where the authors come up with the financial fix. Here the argument is that scholars explain capital markets as a financial fix to structural constraints of the economic and monetary union. The core logic here is that fiscal constraints in the euro area, in terms of a limit capacity for macroeconomic stabilization, lead policymakers to look for other solutions that can stabilize the EMU, and they find it in private market-based finance. And private market-based finance is then used as a solution, as a financial fix to the fiscal problem of the CMU and the problem of stabilizing the CMU. And the argument here is by Braun-Hübner, but also Krüppner, 2011, that
Last in an email. Thank you very much.
Can I go on? Okay. Okay, sorry. So the online audience cannot hear me, or okay. And the key idea here is that public authorities now increasingly govern in the CMU through financial markets and rather than through fiscal policy to stabilize the euro area and the economic and monetary union. And this is basically where our argument comes in, because we argue that by moving from the CMU to the SIU, it's not only building on governing through financial markets, but we argue that this shift also increasingly implies an extended strategy into the digital domain, which is then used to mobilize the savings of households. And the core claim of our paper is that policymakers are increasingly embed macroeconomic governance in digital financial infrastructures, like, for example, data platforms, application programming interfaces, open banking, digital payments, so fintech, for example, but also central bank digital currencies, digital money. And to make this happen, we argue analytically 2 things must happen. So on the one hand, households or household savings must become visible. And on the other hand, they must become mobile to be allowed or able to move cross-border in the EU. And thereby we refer Also for the second argument on this more this international political economy literature that is developed in science and technology studies like Malcolm Camper-Verdon, Carola Westermeier, who work in that direction. And the political economic implication of our paper would be that rather than resolving the fiscal conflict embedded in the CMU, the SIU embeds this into governance of digital infrastructures to financialize households while then relocating this distributed conflict into the standards and payment rails, for example. So this is basically the new mechanism we propose. So, I mean, the first is basically that there's a structural constraint. I can also use the pointer. So there's a structural constraint in terms of fiscal limits, which then explains the financial fix in the CMU. And we argue that through the Saving and Investment Union, policymakers move towards a digital fix, we propose as an analytical category to capture this new mechanism of integration households into the stabilization function of the CMU, also of the EMU. And to make the digital fix happen, we say, okay, then household savings must become visible, and the public and their money needs to circulate in this in the EMU. And this explains then our case selection. So we select 4 cases: 2 on visibility, the European Single Access point, and the Payment and Security Directive. And the circulation, we look at the digital euro and the Vero initiative, which is based on the European Payment Initiative. So it's a private company-led initiative. And this then, in effect, shall mobilize the households and savings of households. So now let's jump into the cases. I think if the first infrastructural layer, we look at the infrastructure of visibility. And here the argument is basically that in order to mobilize savings, investment opportunities, households and financial data must become digital, accessible and comparable. And this is on the one hand what the European Single Access point aims to do. It basically, so the problem here was the corporate disclosure is fragmented across the European Union, across national databases, and what the Single Access point is aiming to do is to provide a single point where this data can be stored and accessed by retail investors, for example, and this then creates a EU-wide platform which creates machine-readable financial and sustainability data, for example. And one example would be that a retail investor in France, for example, can compare financial disclosures also on sustainable issues in Spain and Germany to make an informed decision on his retail investment. Regarding the Payment Service Directive 2, would be the other layer, the other case of making household savings visible. Looks more less on the company side, like the single asset point. So it's basically how the company data that can be accessed, and the Payment Service Directive looks at to customers' data and how the customers' data can be made visible for these investments, and what the Payment and Service Directive 2 is basically doing. So it says, okay, there's a problem that banks historically controlled these data and access to these data, and it opened these data by basically providing these APIs, so it's application programming interfaces, basically allowing fintech to enter the game, and providing apps, for example, that then allow customers to make, based on their bank accounts, investments into retail products they're selling. So the PSD, also the Payment Services Directive 2, then looks into how customers and their data is linked into these digital financial infrastructures. And one example would be that a fintech app, for example, can create a user's bank accounts and recommend investment, for example, saving products based on these data. That's this is possible now through these infrastructures. The second 2 cases, there we look at the infrastructure of what we call the infrastructures of circulation. On the one hand, we look at the digital euro. Here the problem is that increasingly the payment layer is also populated by private platforms, global card networks, read MasterCard and Visa. Here's of course also the layer where international geopolitical challenges, if you wish, come in. And the idea is, okay, we need a European infrastructure that is independent and secure from these geopolitical challenges. And the tool is now to create a central bank digital currency, digital money that allows households to make international transactions based on that currency within the EU. And the example here would be that a user is paying or transferring money from his digital wallet to pay into a retail investment product in another country, and can settle this transaction by using the digital euro. Last but not least, we looked into the Vero initiative, which is while the digital euro would provide the public anchor into the payment infrastructure and public enter into the monetary system, Vero would be the private solution which allows to transfer the money. So customers here can set up Vero wallets and can use these wallets to make transnational payments and instant payments without using or relying on MasterCard and Visa. So basically, it's a private infrastructure that builds or comes in addition to the digital euro and shall secure the infrastructures of circulation. Of course, I mean, while this seems technical, there are of course politics involved. All these cases I presented involve conflict. There's questions about authority, who should govern this. Is it the European Central Bank? Is it European, the legislators? Or, and to which extent, are also private companies involved that run these infrastructures? So the question is, who governs these infrastructures? And there's a lot of conflict and politics involved in that. And that's important to understand the politics of the SIU, we argue. So basically, to come to our conclusion, to summarize our argument, we say, well, what we here find is a hybrid legal technical infrastructure, what we call hybrid legal technical statecraft, which combines hierarchical authority, so EU regulation, with more network-based implementation. And here we build on the concept of heterarchy, with Kier developed, for example, in 2019. So it's a network of networks, for example. And the idea is, okay, we observe this because public authorities define the regulatory framework. So there's a public ecosystem, but then there's also private actors that are involved in implementing this. Like I said, for example, the increasingly fintech firms, but also banks, through that are connected through these API ecosystems, and so on. And the key insight from our perspective is that European integration increasingly operates through digital infrastructures and technical standards, and not only through legislation or fiscal transfers, which is largely absent in the CMU, of course. And the political dimension is basically that this conflict does not disappear, it just relocates the conflict into the infrastructural dimension. So what does this add? To conclude, we think we can make three contributions. We have a theoretical contribution where we extend our concept of the digital fix and speak thereby to the literature on the financial fix and the critical political economy about the the capital markets union, and expanding the digital fix towards the digital infrastructures in terms of the financial fix to expand it to the digital infrastructures in terms of the digital fix. We have an empirical contribution, we think, because this is an underestimated layer, we think, in discussions about the capital markets union and the savings and investment union, particularly regarding the second, because this is here where household savings become important and are directly targeted by the European Commission. Yeah, and we think we will real a political economic contribution because these new conflicts are worth to investigate. Okay, yeah, so this has implications also for the future of European integration, go big or go home, maybe. So I'm making a bold claim that European integration is also moving from market building to infrastructure building, which is I think important also to look at this infrastructural dimension. And then the key political economy question we were trying to answer in our paper is who governs the infrastructure and through which European savings, payments, financial data circulate. Thank you very much for your attention.
Okay, thank you. And I'll just pass on to Lucas for the next presentation. Is that Perry?
Okay, so I'm warning everybody if my voice gives in, I have a microphone. I don't know. Anyway, thanks so much for the opportunity to present this paper. This is a paper that David and I wrote basically as a follow-up to the research project Banking on Europe, which we completed, or at least my leg on the project was completed in 2024. And while David could sit in the comforts of his home in Luxembourg, I was the poor postdoc who had to go to exciting places such as Savigny-le-Temple and Koblenz and bury myself in folders that told us a lot about European Commission borrowing operations in the 1980s. That's the background to this paper. Well, next slide, David. Oh, that explains that. So that's the background. And what I came across in that archival research, and which we then thought is actually bigger story relevant to European integration, is that throughout the 70s and 80s, I came across a lot of materials where it seemed like the European Commission and the European Investment Bank were using their ability to issue debt and their standing as benchmark issuers in capital markets to support financial integration in Europe. And that's very striking, because when we think about the European institutions, we don't think of the capital market presence in the first place. But this was, again, it's not necessarily what we did in Banking on Europe, where we have a fantastic new book, which is available online, right? So that's why I say it's a bit separate from what we do in that book. Bye-bye copy. But again, what we do in this paper is basically to look at the borrowing side of and the capital markets presence of the European supranational issuers, and see whether we can derive broader insights for the role that supranational financial institutions might play in terms of financial market governance and specifically financial integration. So that's what I'll be talking about here. So basically the idea is to say that we want to contribute to the literature that has looked at the role of public institutions when they transact directly in financial markets as a way of governing, of achieving public good objectives. And to do that, we want to basically conceptualize how supranational actors might do that and what sort of objectives they might pursue and what tools they might have at their disposal to do that. And being very modest in our empirical scope, we do that based on 70 years of supranational borrowing in Europe. So the literature that we want to engage with, obviously, this entire work on how we got international financial market integration, which is a very, very big subject, and a lot of people have made very sophisticated arguments on this. So we're not claiming that we have the theory of why we got international markets integrated, but the point is more to add one additional layer and say, look, we have this work on deregulatory policies, we have institution building, we have financial infrastructures, we have all of these things, we have ideas, we have structural power of financial markets, all of that. And on top of that, we also have purposive supranational actors that use their financial market presence to achieve these objectives. And we conceptualize this based on some work that has developed conceptual frameworks for thinking about how public actors might transact in markets. So Hockett and Omarova is the key paper for that. And more recently, Bastian van Apeldoorn and Nana de Graaf had a similar paper where they think of ideas that market interventions could aim at creating market segments, they can aim at correcting market outcomes, and they can steer the development of markets and market direction. And we basically adapt that to the context of what that might imply in the context of international financial market integration. We interact obviously with a very surprisingly small body of literature on public debt management that has looked at these kinds of operations at the national level, but there's not that much. But we in general think that this is not just applicable to international financial integration as well, but also that if we apply this to supranational institutions, it might actually give us new insights into new dynamics. To get to this point, we look a bit at what distinguishes institutions such as the ESM, which is about 200 meters that way, or the EIB, which is about 2 kilometers that way, from national debt management offices. And one thing is that we have these two different kinds of bodies, right? The ESM is a bailout fund. The EIB is a bank. And of both of these types of institutions, we have several others in the world that can issue debt on capital markets. And actually, in terms of capital structure, the EIB and the ESM are quite similar. But the EIB and the ESM are both by far the largest of their kind, right? So they're pretty big issuers. They both have a AAA rating. The Commission also has a AAA rating. But that puts them in a position where they can potentially provide a benchmark, where they have a sizable market presence, So just to give you an indication, in a moment here, to give you an indication, we have the, oh no, let's see. So here we see, this was, I think, this is still last year's presentation. So by now the Commission is close to overtaking Spain in terms of outstanding debt. Commission has, and you see further down, we have the EIB and the ESM in terms of their net issuance. They're still comparable to smaller sovereign issuers in the EU. So that's a considerable market presence. And as such, they can influence markets just by their standing and by the size of their issuance. And then also, interestingly enough, they're fairly autonomous in their debt management, because this is largely seen as something operational. So, you know, the board of directors that can usually say, oh, we want you to do this and that, but the funding departments are usually, that's too technical for the directors to get involved with. So they usually get some broad guidelines, but they have a lot of autonomy in terms of initiating new things. And finally, what is unique to these supranational issuers is that they're not beholden to a national home market, right? So if we think of European monetary unification, for example, then obviously the Germans and the French, they also had their ideas, but they had their German and French primary dealer networks. The European Commission, the ESM, they don't have that, right? So they are by default engaging with a more regional financial network. And on top of that, they have an explicit mandate to support regional financial integration. And David and I, we had an interview not too long ago at the EIB where we spoke to somebody in their funding department who told us very clearly that the EIB has seen itself for a long time as using its debt management operations to support its mandate for supporting the European single market. So they clearly see that as part of their organizational mandate, that they also don't just use the lending, but also the borrowing. So that's the starting point. That's why we think there might be something. Here we go. It starts in the 1950s. So this is the first loan that the European communities ever took out was from the United States to the coal and steel community from the US Export-Import Bank. And back then, the idea was really that Europe needed hard currency and that the European states couldn't borrow very well. And that's why they set up this community. And well, it turns out that the European coal and steel community very quickly issued on international capital markets and brought dollars into the European communities to fund the heavy industries. The EIB had a very similar motivation that in the late 50s, early 60s, the idea was we want to tap US capital markets and basically channel those dollars here, and they could usually do that at conditions better than those of any of the individual states. So that is a very clear way in which we say this is a way how they can influence capital flows, how they can influence basically these sorts of market outcomes. A much more recent example looks like this. This is the European Commission's, what is it, advisor hors class, Siegfried Ruhl, so the guy who basically just reformed the European Commission's debt management, pitching the Commission as an investment to investors from the Gulf. And in 2021, there was a communication by the European Commission, which was then endorsed by the Eurogroup, in which they said very clearly, we see European federal debt as a way of supporting the international role of the euro, because if the Commission suddenly issues on the scale of Spain, that means that we have a lot of European AAA assets. The Commission, as of now, is the third largest AAA rated public issuer in the world. Have a lot of AAA rated assets that we can sell to foreign investors, and then we thereby strengthen the international role of the euro. So this is still a concern, and this is actually the Commission is currently working on a follow-up communication that's probably going to double down on that message. And the ESM and the EIB have likewise basically joined this idea of having European safe assets to pitch supranational debt to support the international role of the euro. So right, this is how we think of how we can use the debt as an instrument in market governance. Now, when it comes to market segments, we have all kinds of funny anecdotes, how the European coal and steel community almost started the euro-dollar market and then basically didn't do the paperwork in time, and that's why the coal and steel community was on the second actor to issue a euro bond ever. Then another interesting story is the Americans, obviously, in 1963, they basically made it much more difficult to access US capital markets, and as a result of that, the EIB here in Luxembourg, the European Commission's funding has also always been here in Luxembourg, They had a very strong role in developing the euro-dollar market here because they would then issue their dollar-denominated bonds to the European banks, in part here in Luxembourg. And that culminated in the first loan that the European Commission took out that was secured against the community budget in 1976, in which it put together a syndicate of about 300 European banks, mostly, to issue a bond at conditions better than Germany could have got. So again, this is something where we see that they can actually develop market segments and scale up in a way. And then, through the 1980s, there are lots of other examples where they issued the first floating rate note in this or that currency. I'll go through it in a moment. But this is how we think of what it would mean to develop market segments. And this is one of the most fascinating findings of all this. This is the different currencies in which the European Investment Bank borrowed throughout the 1980s. And you see the share of the European currency unit, of this synthetic indicator that was constructed prior to EMU. And it was the largest funding currency until the Maastricht Treaty, and then it was mission accomplished. And well, they didn't do that anymore. But what they did instead was that the EIB had a very explicit commitment to supporting European monetary unification. They issued the first tributary bonds, the first Euro global bonds. They had a very early commitment to setting a Euro benchmark, and it's all in the paper. It's just a lot of firsts that the EIB did. And again, as a very explicit matter of policy. This is obviously, it's not the EIB wasn't the only actor to do that. The Giovannini Group did basically a similar effort among sovereign issuers. So we're not claiming that the EIB is the only one to do that, but the EIB absolutely did it, and it definitely had an impact on the market. And the latest example are green bonds, where the EIB has not only issued the first green bond in history. I mean, they kind of have a fight with the World Bank of who was the first one, but EIB issued the first security linked to green investments. But also the EIB is still the largest issuer in history of green bonds, with about 130 billion in green bonds issued. And you know who was the largest issuer by volume last year? The European Commission. And again, this letter from 2021 by the Eurogroup is very explicit in that. We want to use the issuance of the European Commission and the European Investment Bank to support the EU standing as the prime market for green bonds, because currently half of all green bonds in the world are issued on European capital markets and denominated in euros. And it's a matter of European policy that the EIB and the Commission through its NGEU green bond issuance support that. So this is, again, to us, pretty clear indication that this is a longer running use of these borrowing capacities for strategic purposes. The third one links a bit with Sebastian's paper, which is the building of infrastructure. It's a bit more technical, but that's basically the financial market plumbing that goes into that. So the EIB started that in 1999 when they tried to position themselves as a consolidated issuer, and they had a reference network issuance scheme. The Commission had its first issuance program in '94, I think, right? Yep. So they started that around that time. And the EIB also, interestingly enough, in 2001, they already had a repo arrangement with the bank, but only in sterling. So don't ask me why that, but they started these kinds of things pretty early. And then with the EFSF and the ESM, so once the bailout funds came about, they actually developed a pretty sophisticated approach to supranational debt management, which is another paper that David and I have been working on, where they started to manage supranational debt, basically like national debt management offices. So the EFSF developed an approach to having auctions and having a primary dealer network and having a bond and bill program, basically all the things that national debt managements do. And this requires you to put together a primary dealer network, and it requires you to put in place settlement infrastructures. And once the Commission had to fund NGEU, they took Siegfried Rubel, the guy who had done that at the ESM, and they took him to the Commission as an Hochklasse advisor, and he did the same thing there. And as a result, the Commission is now institutionally basically a supranational sovereign issuer. Like, they have also auctions, and they have a repo facility, and they have bonds and bills, and they settle their stuff in European central bank money, which is something that the sovereigns can't really do. And all of this draws on a wide cooperation of different national central banks of the euro area. But this is what the Budget Commissioner recently called their drive to build an ecosystem for EU bonds, right? So if we think of all these approaches at developing basically the market infrastructures that investors are asking for. That is in a sense creating a genuine issuance framework that is supranational, that a national issuer could not develop. The Commission's primary dealer network spans almost 40 banks from all over Europe, right? No national debt management office could do that. And the other thing, which especially the EIB has been very good at, is whenever there was new European capital markets legislation, the EIB tried it out. For instance, the first green bond that they ever issued was the first bond that was issued in parallel in all EU member states under the passporting directive of the Lamfalussy plan. So the EIB does these kinds of things. When they're now working on a wholesale digital euro, we can bet that the EIB is the one who's trying out whether that stuff works. Right, so that in that sense, the EIB also has just a very practical role in trying these new pieces of legislation and seeing whether the settlement systems that the Banque de France develops works. So this is also a role in which they can support these initiatives at the European level. I come to the conclusion. The story is not that we have a completely new explanation for how capital markets integrate. The story that we're telling is there is also a role for supranational institutions that is very distinct in the sense that they have a distinct institutional position, which, thanks to their supranational standing, and at the same time they have the market heft and the intentions and the autonomy to make a distinct contribution to regional financial market integration. And in Europe, we obviously have a most likely case given the institutions that we have here, but I think this argument might carry further than just Europe. And we've done some interviews that indicate that it might also happen in other contexts, but Europe might in a sense be a bit more unique. The three strategies that we've indicated are all at this point still a bit indicative, right? But we see that there have been efforts to redirect capital flows. We see that there have been efforts to develop new market segments, and definitely there have been attempts at developing new market infrastructures at the European level that basically only supranational actors could pursue. And this is the case that we make here, and now we think of further implications for that. Thanks so much.
Okay, perfect. Great. So most of the presentations, maybe this panel has been a little bit more historical, but most of the presentations yesterday were sort of forward-looking, right? Understanding these newer and more aspirational aspects of the SIU. And so I'm going to look backward, specifically at the banking union and elements of it which have been folded alongside the capital markets union into this larger SIU project. And what I want to concentrate on today are a couple of residual elements of the banking union that have yet to be completed, focusing specifically on bank resolution. And these residual elements fall under two broad and related camps. So we have on the one hand backstop mechanisms, which include the Single Resolution Fund, the European Stability Mechanism, and the European Deposit Insurance Scheme. So the SRF has limited funds available, subject to very strict conditionality. Reforms to the ESM have been blocked by Italy and likewise contain really strict conditionality. And EDIS, of course, has been essentially abandoned despite being the third pillar of the banking union. And then on the other hand, we have a series of technical problems, which include limited operational flexibility in a crisis and barriers to the fungibility of capital in a resolution. And these residual problems have one thing in common, which is that they all concern the fiscal capacity of the state. They require explicit commitments to mutualize debt and to share burdens. And I'm going to come back to this point. So this paper, I think, makes two core contributions. The first is to this larger special issue in inspecting the foundation of the SIU. And I'm using the word foundation here in the sort of architectural sense. I'm interested in the components that lie underneath, right, that hold up the more visible arrangements of the SIU. And this is particularly important because the SIU is obviously explicitly intended to foster deeper and more complex interconnections among a range of larger and more complex EU financial institutions, right? If it's kind of implemented as written, it will clearly increase the spillovers associated with a future financial crisis. And without adequate preparation and procedures, this can threaten to sort of return us back to where we started, right? With banks and other financial institutions, which are only European when things are going well. And the second contribution, I think, is to better situate prior research on the banking union within a larger global context. because these reforms to the EU resolution regime, they didn't occur in a vacuum. They were in fact a diffusion of international standards that were negotiated before the banking union came into view, including by EU member state authorities. And as a result, the EU's resolution regime has to be both internally consistent and complementary with that of their foreign counterparts. And so I think this discussion is useful for understanding sort of not just European financial integration, but also larger patterns of global financial integration. And so in the paper, I sort of proceed to outline the development of these backstop mechanisms through three successive stages of transformation. So in stage one, which I label a process of translation, we have a global process of developing standards for resolving cross-border banks. And in stage two, we have the banking union, where those international standards are then implemented through EU institutions in a process that I label as transposition. And then finally, we see stagnation at the third stage of transmutation, where member states have thus far been unable to acquiesce to the fiscal integration that's necessary to complete the banking union and thus finish laying the foundation of the SIU. So I'm going to spend most of my time talking about stage two, but just as some quick background that's in order. So before the banking union emerges as a policy priority, so from around 2007 to 2011, the nascent Financial Stability Board developed the key attributes of effective resolution regimes for financial institutions as a set of international standards for bank resolution regimes. And this proceeded much like pretty much any effort at global regulatory harmonization through the sort of Basel process, but with a very important distinction, which is that measures that are aimed at managing financial crises, as opposed to the sort of prevention efforts typical of earlier Basel work, these require burden sharing and binding commitments. And for students of international relations, you'll know this is where international agreements typically go to die, right? Once you're dealing with these problems, agreement usually doesn't occur. And so to square this circle, I argue that regulators engaged in a process of translation. And now, I know I'm one of the few native English speakers in this panel, so I don't need to explain the pitfalls of translation in this room. But of course, you translate text into a new language and the general meaning is understood, but there's very important nuance that gets lost. And so we see this with regulators attempting to shift the fundamental questions of state sovereignty embedded in resolution into technical puzzles about rules and procedures, trying to develop rules which incentivize cooperation without binding it, using the language of technical standard setting. And the key attributes do this in two ways. One is through pre-positioned bail-in capital, which is designed to disincentivize ring fencing, and the other is through contingency planning exercises, which are designed to develop trust. And generally speaking, these are relatively effective mechanisms insofar as they serve the general purpose of providing mechanisms for managing crises, but they of course aren't substitutes for binding agreement. They're very fragile. And this is where the story ends for most major financial centers, right? The US, Japan, the UK, Switzerland, right? They've adapted these rules to their domestic contexts, and now most of them have at least a reasonably functional and broadly complementary domestic resolution regime. But implementing these standards into the EU requires adaptation to a very unique institutional context. It requires transposition. And so I don't know if any of you are classically trained musicians, but in music theory, transposition refers to the process of shifting a composition into a new key. Usually this is done either to change the instruments that a piece was written for or to accommodate the range of a vocalist. So in music theory, this is a really common and very useful skill for composers, but it creates a couple of distinct problems. So the first, transposition, it creates harmonic problems because shifting keys, it can lead to what's called tonal dissonance. So if any of you play piano, you'll know that as you shift down to the lower notes on the left side of the keyboard, right, the lower tones, the notes can sometimes bleed together, right? They can sound a little muddy. And at the same time, if you shift to the higher end of the keyboard, right, the higher tones on the right side, it can sound kind of the opposite problem, right? It can sound a little thin or brittle. In other words, transposition can make a piece either sound more convoluted or it can remove necessary depth. And second, transposition can create instrumental problems, right? Where a composition might be difficult or even impossible to play on a new instrument. So if any of you play guitar, you'll know there's a lot of very simple chord progressions, and many of these are literally impossible to play on a saxophone. Like you can't actually position your fingers in a way to make it possible to play. So now you not only have to change keys, you also have to rearrange the progression and find alternative notes. And then finally, transposition can create cognitive problems because as you introduce layered adaptations to deal with the harmonic and the instrumental problems, you create confusion, right? You can end up undermining the original intent and meaning of the piece. And so the core harmonic problem in the EU's transposition of the global resolution standards, it centers around a very complex chain of decision-making. So in the interest of time, I'm not going to go through this whole chain, but essentially any resolution needs to coordinate between the SRB, the ECB, the Commission, the Council, and all of the relevant national authorities, including, most importantly, the home country resolution body and ostensibly their national government. So this is a lot of players. And this chain does not make clear where authority lies if any of these parties disagree. And as a result, the national authorities have de facto veto power over a resolution for their jurisdictions, despite having ostensibly delegated this authority to the SRB in theory. And of course, all of this has to take place over a weekend. So another way to think about this is that the emerging EU resolution regime at present adds a third level to what might otherwise be a two-level game. Right? National authorities need to determine what options will appease their domestic audience. They need to bargain through EU institutions for solutions that meet their obligations. And they have to do all of this while presenting a united front in their coordination with third countries outside of the EU, whose cooperation is also necessary when we're talking about the largest EU banks, where these problems are the most salient, and where, as we saw with Lehman Brothers, the consequences of a failure to coordinate are the most grave. And next, we have an instrumental problem. So at the global level, pre-positioning bail-in capital among subsidiaries can embed cooperation by reducing the payoffs associated with defection in what could be essentially modeled as a prisoner's dilemma. So if you gain less from defecting and you gain more from cooperating, you'll probably cooperate. And this is sort of all well and good in a global setting. But how this is manifested in the EU reveals a fundamental level of distrust among the member states. So this pre-positioned capital, it's called MREL in the EU, TLAC elsewhere, it's more or less the same. This is subject to higher quantities and more stringent use conditions internally among member states than externally between member states and third countries. So we get to this counterintuitive conclusion where in the arena where states have integrated the deepest and ostensibly delegated authority to a supranational body, states are actually less willing to assume that cooperation will emerge and have created more complex insurance mechanisms to disincentivize cooperation. And this is both a practical and a conceptual problem. So practically speaking, barriers to the fungibility of capital make it very difficult to respond flexibly in a crisis whose future conditions are very unclear. And conceptually, increasing the fungibility of capital is the entire point of the SIU, right? It's what we've been talking about the last couple of days. And so the fact that member states are unwilling to accept it, even when it's most necessary, suggests to me a sort of structural barrier in the level of integration that the SIU is attempting to achieve. Lost my place here. Yep. Yep. Sorry. Vision by the SIU. It's 10. Okay. And then finally, we have a cognitive problem. So these strict positioning requirements and even stricter rules on how losses can be absorbed, in what order, using which tools, it creates a rigid set of procedures, a lack of credible alternative strategies, and an unclear site of final decision-making authority. So returning to our music theory analogy here, this has undermined the original meaning of the composition. So the global rules that I mentioned in stage one, these were explicitly designed to be flexible. It was understood by everybody involved in drafting them, including the core EU member state authorities that were representatives in these meetings, that whatever resolution plan was going to be drawn up for a large global bank would be abandoned at the point of crisis, right? That the point of the exercise was the process of planning, not the actual substance of the plan. Most of the Europeans I interviewed, they quoted Clausewitz here, right? That no plan survives first contact with the enemy. The Americans I interviewed quoted Mike Tyson on this front, that everyone has a plan until they get punched in the mouth. It's the same principle, right? That what's important here is that you plan, not the actual rules themselves, right? What was needed here was an adaptable set of tools that could be applied across a range of circumstances with a clear and unambiguous authority designated to wield them. And the EU's transposition has achieved the exact opposite of this, with a few blunt knives in a kitchen that has too many cooks. But these rules have been implemented and enshrined in EU law. And where this process is halted is in this final stage of transmutation. And this is a concept that's usually sort of associated with medieval alchemy or divine intervention, right? The sort of spontaneous changing of a substance into a higher form, right? Turning iron into gold or turning water into wine. And here we come to the failure of member states to agree on backstop mechanisms for the resolution regime. So they've established the single resolution fund to finance a resolution, but the amount available is very limited. It's probably inadequate in a systemic crisis. And access to it is subject to stringent conditions which limit its operational flexibility. And the backstop to this backstop, the reformed European Stability Mechanism, is also subject to strict conditionality, and its use for this purpose has not been ratified due to Italian opposition to that conditionality. And then finally, an alternative backstop in the form of EDIS. This hasn't materialized at all, despite being a core pillar of the original banking union. And as I said up top, what these elements have in common is that the buck stops with the fiscal authority. So this is the case in every other relevant jurisdiction, right? The US, the UK, Switzerland. They all have legal mechanisms for the state to step in. But of course, at the European level, there's no state in the fiscal sense. And national authorities can't take on this responsibility given the fiscal rules, the spillovers, the lack of monetary autonomy, and the like. And so what this reveals, I think, it speaks directly to several of the papers that we've been talking about, right? This is an issue of fiscal federalism, right? Not intergovernmental bargaining. Member states have no choice. They can't leave the EMU. And so debate becomes about the terms under which they're willing to share burdens. And crucially, their failure to agree on those terms doesn't mean that they won't have to share in the end. It just means that those burdens will probably be larger than what they otherwise might be. So to conclude here and bring this back to the SIU, we can see some risks start to emerge, right, or cracks in the foundation. That the initiatives that we've been discussing, they promise deeper financial integration and more complex institutions, more complex infrastructures, more interlinkages among member states, with the ultimate goal of a sort of pan-EU market for financial services. But to do this without the transmutation from intergovernmentalism to fiscal federalism, right, without a backstop, member states may be recreating the problems that emerged in 2008, right? A financial system which is European in life, but national in death, and where conflicts among member states and supranational authorities exacerbate panic, right? Making the next crisis, however it might manifest, probably worse than it otherwise needs to be. And, you know, Eric Jones and others might maybe argue that we maybe need to see this crisis, right? We need to fail forward. We need to witness this crisis in order for these problems to be solved. But I would say probably if you live on a fault line, you maybe want your house to have a solid foundation. So I'll end there. Thank you.
Full papers indeed. Yeah, thanks so much. I really think that's all really cool political economy work that I had the pleasure to read. So thank you all. Half of that is for the special issue. The other half has its own life. So I took my position here as being the so-called critical friend, right? And I have to manage time a little bit. 3 observations for each of the paper. And I start with Sebastian. So this has been a super rich read and really learned a lot, particularly about the initiatives that you've chosen as cases. Really like to learn even more about if I should use Vero now or not. That's super interesting. And my 3 observations start with the overall structure and framing. I think you mentioned that a little bit. For my personal taste, there's too much happening at once in this paper right now, and I think you restructured your presentation already to that fact. Most importantly, I think the editors could say something on how much history of CMU you need for that paper and talk about this. And then some of the concepts you mentioned but never used, like policy entrepreneurs or something like that, cut it away, I believe. And however, I think the most important issue here is that what kind of implications and dimensions you want to aim for. I mean, for those who haven't read the paper, Sebastian and Pavel in that paper are talking about the impact on depolitization of distributive conflict, core periphery asymmetries, rise of private intermediaries, financialization of everyday life, super huge debates, super huge concepts, and I think you have to make a choice, right? So for example, you have a section called financialization of households, but you don't talk about that debate or about that at all. So either cut it or make a choice for what you want to focus on. And my personal recommendation would be kind of to really substantiate what you call a digital fix, right? Because right now I'm not buying it completely. Does it have a Harvey connotation or doesn't have a Harvey connotation? I'm not sure. Maybe you can really buy into this a little bit more. The second point would be case selection and presentation. You write that cases are strategically selected instead of being representative. This is fine, but as a reader, I do not get a good image of what is the pool of cases in Savings and Investment Union in terms of what are the initiatives at all. Are you giving us some flagship projects here? Or are you giving us like, how many are there? I have no clue. So I think a clearer research question would help, something like how are savings mobilization and payment integration operationalized or achieved under the SIU umbrella? And I think your answer is through digital infrastructure statecraft, something like that. And something you can really capitalize on more is you have in the end, with your cases, you have a wonderful social scientist desire fulfilled of a 2x2 matrix of case selection. So maybe, right, visibility and circulation on the top, public and private authority on the left, go for that. And third point is analysis. I have to admit that the structure did not come straightforwardly to me. I know it's about visibility and circulation, but you move into a paired comparison or something like that. So maybe you should explain that a little bit more. And I think the problem right now would be that you mention we're doing a narrative analysis, we're doing process tracing, we're doing institutional analysis, and none of the things you're doing right now properly and rigorously. So also here, make a choice. We're conducting institutional analysis or something like that, and then follow up on that. So otherwise, this looks great, and I will also send you my comments in written, so you don't have to write everything down. I will send it to you as well. So Lucas and David, two things that I really like about the paper. First, highlighting the role of debt issuance as a market activist tool. That's really cool, and I really like the historical work you've done, the historical evidence. That's really convincing and interesting. And by the two things that you here that I like, you might also already see that I have to kind of lift the wheel of the double-blind peer review because I've been one of your reviewers. So you don't have to, I won't send you the comments because you got them. And I believe, I can say that because I believe my concerns with the paper were not completely unjustified, and also as reviewers we have to stand by our words, and I'm just doing that right here. So first of all, I repeat for the sake of the discussion as well, right? I think you have to be clearer about what actor you're talking about and how that travels, right? Here on your presentation, you were focusing on the supranational issue. That was a European integration focused presentation. But on the paper, you are sweeping intergovernmental, supranational, sovereign, right? I think you have to pick and really tell us about what kind of actor you're talking about here being in the moment. The second point I would underline is about these three strategies you have, right? I'm still missing the mechanisms about how that actually works, right? A number of points, but I think the most important is like also similar point to Sebastian, also make clear what is your case study selection strategy, right? You're having some, it is now appearing to me as this is representative of something or illustrative case studies, vignettes that we were showing, but it's not clear to me how you pick these historical episodes. And one way you could do this or bolster this more is saying like, either we have an idea about the condition, the independent variable that's important here, like the strategizing on we want to steer markets or something like that, or it's something on the outcome side, on the dependent variable thing like financial market integration, something like that. You know the details, and we can discuss over the coffee break a little bit more. Happy to support and not being a reviewer too. Mareike, so first of all, I love what you're doing, and I think that is what so many British-based political economists can do very well, like engage a prominent position in the literature and say how you provide an alternative or complementary position to that. And I think you do that really well for that critical political economy lens towards European financial integration. I love that about the paper. My three arguments or observations here. First about the argument. Particularly tackling critical political economy. You show that the euro-dollar markets were a key space for European integration, and European banks were key agents for the making of US dollar hegemony. But it remains unclear to me what that means about like the conventional argument that the end of Bretton Woods restructured monetary and financial integration in the European Union. So we're in Luxembourg, so the Werner plan failed. Became a victim of the currency turbulences of the 1970s in particular, and maybe it is, you don't seem to engage with that at all. And maybe that is because you have a clear separation between financial and monetary integration, but that could be something you could signal even more. And maybe because you have a focus on the 1960s reform proposals, you frame as banking union avant la lettre, so to speak. But if this is correct, then the paper may benefit from a clearer delimitation of what you are looking at. Secondly, approach. You employ both a radical historicism approach and the global credit view. So if this is a standalone paper, I would suggest to explain both a bit more. You mentioned radical historicism once as a side note, but you don't let anyone in on what that actually means methodologically for you, how you approach your data. And while the global credit view is more prominently introduced, I think it needs some more refinement how you work with it. Do you distinguish between the global credit view and critical macrofinance? Is it the same? Is the point really that existing scholarship has ignored currency hierarchy? I don't think so. That reads sometimes in the paper like that, and I don't get like the point about interlocking balance sheets. I don't know that the critical macrofinance is about this, but I don't see that in your analysis. How interlocking balance sheet is that's a balance sheet analysis what you're doing. So maybe you just clarify how you move into that. And the final point is empirics. I got a little bit lost in terms of historical time. So you seem to cover a period from 1960s to the 1980s, but you jump between some periods. So for example, the city's position towards European regulatory initiatives, I think depends very much if it's pre-1972 or post-1972, UK accession to the European Economic Community, but you don't mention UK accession at all. You don't mention 1974 Basel Banking Committee founding. So it seems like there's something, a lot of things are also happening, but you don't touch about them. And I'm losing a regulatory timeline or something like that. And for radical historicist approach, I believe you can do that more sensibly. Finally, Will, I'm good in time. Okay. So that is quite an enjoyable read. Despite being a technical paper, I think that is due to your very innovative views of the concepts, particularly, of course, the part of transposition. I really enjoyed this in the paper as well. So I would like to begin by saying that this is a great feature of the draft that you should be keeping, if I was the editor. And the other thing that really resonated is your argument about resolution and financial integration, moving from being a problem of international relations to fiscal federalism. I think these are the two key points that are really great about the paper. So my three observations here. First, the framing. I have understood that the special issue is about the Savings and Investment Union, and in the presentation you did a lot to kind of anchor the banking union idea into that, but in the paper I believe that could be a standalone section really thoroughly introducing to people empirically and theoretically how banking union resolution is linked to a functioning savings and investment union. I think you can do that. It's there, but it can be expanded. Secondly, the approach. Currently, the paper has neither a theory nor a method section. You can have a section on music theory, of course, but I think you could use a dedicated section to kind of spell that lost in translation framing from the title a little bit out, maybe talk about how you engage with existing uses of the terms you use in political analysis. So actually there are people using transposition and transmutation in EU policy analysis. So maybe you need to kind of at least engage a little bit in the literature and use the theory part to talk about that shift from IR problems, bargaining problems, to fiscal federalism. I think that would be great. And finally, the empirics. I think it's still a technical paper. I don't know. I haven't seen anyone writing on resolution, making a resolution without writing a technical paper, because it is so technical. But it will be, if I understood correctly, competition and change. So there will be political economists broadly interested in the political economy of finance. So you have to scale down a little bit of the abbreviations, right? It's like the TLAC and the MERL and kind of it's like spinning your head a little bit. So I think if you can frame that in broader political economy terms and reduce the technicalities to one single point in the paper, it would be probably helpful. But taken together, that was an enjoyable read. I feel awkward about having to reveal my peer review identity, but otherwise, really enjoyed it. Thanks a lot.
Okay, so thank you for the wonderful presentations and papers. So comments or suggestions. I start with Lucas and David. In particular in the presentation, but also in the paper, I think I would like you to tease out a little bit more the agents, the actors who are doing what. And of course, the EIB is one of the key actors, but then what are the other actors which are supporting what the EIB is proposing or are actually pushing back against it. So a little bit the politics and the agency and the actors were a little bit hidden in your story.
For other reviewer?
No, I'm not, but second, then the comment you, I can't read my handwriting, to, what is this? Oh, look at that. Oh, yes. Sorry to Sebastian. It's my handwriting is terrible. So it's me. I always have a little bit of an issue with the fixed concept. I mean, in particular, the financial fix and digital fix. So I was wondering whether you could spell them out one more time for me, but also empirically, how do I recognize a digital fix or a financial fix when I see it? Is it equivalent to a compromise or do something by stealth? So in terms of empirical observation, how do I recognize and how I distinguish a fix from compromises, negotiation, or other similar terms? And then to William, I really enjoyed the paper also because I worked in the past on the first stage of your, if you want, story, the making of the Financial Stability Board key attributes. And so I like it. I think also your word transmutation, it fits very well with our paper on saints and sinners and converts. So I was wondering whether we are having a bit of a religious stream running through the special issue. But again, in terms of semantic or linguistics, so I fully understand. I'm not a connoisseur of music. Why you use the word transposition for stage number 2? This is transposition, but transposition is also very technical in the European Union languages. Basically, it's when directives are transposed into national legislation. So I was wondering. So you explained it very well verbally and in the text, but then if I if I were to look for a different term, I would go maybe for adjustment or something, adjustment to European specificities, which is often a language also used by the European Parliament when tampering with anything coming from Basel that they don't like and they want to put into European Union legislation. So adjustment or what I can interpretation. But I can also see why you kept the language of transposition, even though it's not transposition in the European Union legal terms. I was wondering, so basically, one interesting part of the story I wasn't aware of is that the pre-positioning of TLAC or MREL capital is more prescribing in the European Union that it is internationally. And your argument is that because member states don't trust each other, which I think is true mostly, but I was wondering maybe also because the degree of financial integration is much larger or deeper in the European Union. In particular, there are some host countries in the European Union, I'm thinking like the Baltics, that really have a big part of the banking sector that is dominated or whatever controlled by home countries. So in other jurisdictions, I'm not sure you have the same extent of foreign bank penetration, whether this might explain why. So maybe Europeans don't trust each other that much, but also in certain particular parts of Europe, very deep degree of financial banking integration. Thank you.
Okay, someone who's struggled to get my head around MREL and TLAC myself, I share some of those comments. Also, I think it's not just, it's not a question of mistrust. It's also, I put down the required MREL levels in that JCMS piece I wrote with a former PhD student. We put it down to configurations of national banking systems. So it was a much more political economy explanation as well. Also, but I thought your comment about this is really a matter of fiscal policy. It's a fiscal policy story at the end. I thought yes, it's true to a certain extent, yes. And after all, but you have to keep in mind that the SRF, of course, the Single Resolution Fund, which is now 81 billion euros worth, is funded by banks, right? According to criteria, and obviously bigger banks with higher risk activities contribute more, and so on and so on. And also then the European Stability Mechanism, the ESM, which may someday, if our Italian friends agree, may become the backstop to the SRF. Okay, yes, in theory, that there is a fiscal policy implication potentially, and this is why some governments, notably the German government, not just the German government, but are obviously concerned about how the ESM operates and where the money goes and so on. But nonetheless, most of the money won't come from, it's only in case the money cannot be recouped that it will come from obviously markets, be raised, debt will be issued on markets by the ESM too. So is it really a fiscal story? I don't think it really is, but anyway, that's it. Oh yes, okay. Is it allowed by the chair? Ava, chair.
So this may be because David and I were both nerdy about EU supranational debt issuance, right? So I have a very similar point that I want to add, which is, how do you think of basically the how can I say the finalité, like the end point of the process that you're describing? Because to me it sounds indeed like you're looking at basically a fiscal union as the blueprint, where you say ultimately we can only ensure that we can bail out the banks if we have a kind of fiscal sovereign who's standing there. And when we look at the creation of supranational financial mechanisms such as the SRF or the ESM, or even borrowing by the Commission, you have a stream in the literature led by people like Waltraud Schelkle who say this is actually not about the creation of outright state-like capacities at the supranational level, but it's about the creation of reinsurance schemes that backstop national capacities. And I think that what you have there is something that should really engage with that debate. And I think that would get you to all the points that David makes about, look, the ESM is not fiscal because it's actually set up as a financial institution that borrows money. Look, even the SRF can borrow money in capital markets, right? So these things.
The SRF potentially borrows. We were debating Should it be treated as a supranational bond? Yeah, sorry, that's the nerd. That's right.
I think that's where, yeah, that's what we.
So a couple of thoughts. First, I think you can't make more of the misconception, as I would call it in the EU, that TLAC standards can apply to each and every bank through MREL. The reason why I'm saying that is because TLAC, for those who are not familiar with these wonderful acronyms, so the total loss absorbing capacity, which is essentially a layer of hybrid instruments that are there in order to cushion losses that the bank has incurred, and also serve to recapitalize it if it is not sent into liquidation. And that only works if you can issue this stuff on capital markets. And most of the European banks, like 90%, don't have access to capital markets. They're funded through equity and deposits. So therefore, the whole idea that you need a capital markets union somewhat, I think, plays into that, because that would also probably lower the threshold for many banks to access capital markets. I'm not sure if that actually works, but that's one thing. The second thing, if you're talking about our neighbors, the European Stability Mechanism, as being able to borrow on financial markets, that's true in theory, but you need to look at the governance structure. There has to be an anonymous vote to do so in the governing bodies, which will never occur. So Germany is never going to allow that, for example. So only if you have a real big financial crisis. And also, in theory, they can. So that's one thing that is also important. I mean, they can always have exposed contributions from the industry in order to refinance what they borrowed in financial markets. So, it's unclear to me whether that's really a fiscal thing or what it is. And the last thing that I have for William is you can also make, I think, a little bit more of the fact that what happened in the banking crisis that we observed post 2014 is exactly what you are probably getting at. The European system doesn't work, but of course you have to clean up once it hits the fan, and the way you do it is national. So all the banking crises that we saw, except for the one where you had this very, very exceptional situation where you had a private sector backstop. So when they were simply taking over the bank, we're all dealt nationally from national fiscal capacity. And that, of course, is counter to the idea of the banking union, because then fiscal capacity of individual member states all of a sudden still matters. So, technical paper, but I guess it's even more technical if you look deeper. But I think these technicalities explain the dynamics, and I think that's super interesting.
Okay, I will now give back the word to the presenters, and then we do the second round. You have to wait for a second. And thank you. We start in the order of.
Yeah, thanks very much for all these very helpful comments, particularly Daniel. So thanks very much for reading it and commenting on it. I mean, I have to admit, this is of course an early draft, or it's a draft paper. So many of the things you said, I mean, this is exactly what we're trying to do now, to polish the paper, to be clearer with the concepts, maybe to cut some out, and then also, to make it just cleaner and then the story more convincing. Let me say a couple of words. So what we were trying to do is we looked also at the special issue we're editing. So it's competition and change. There was a special issue which introduced the term of financial fix. So we're playing around with that one and saying basically, okay, the financial fix is a response to the missing fiscal capacity of CMU. So we need something that stabilizes the EMU. And this is where the financial fix comes in. And then we said, okay, look, something the SIU is now targeting households and their savings. So what is required for doing this? And this is where we played around with the concept of the digital fix. And then Lucia, yeah, indeed. So what we're trying to do, I think we need to be more clearer about what we mean by that, and maybe identify some indicators to make this even clearer. But the idea is really that it is builds on the financial fix, goes one step further. It's not just, you know, kind of the outcome. It's more of a process that integrates or uses the financial infrastructure to stabilize also, to perform the stabilizing function in the EMU. So it's really kind of a reorganization, reinterpretation of also even existing infrastructure. Some of these legislation is older than SIU, like the PSD2 directive, which then kindly, or we saw it, and we would maybe not introducing another concept, but linking it also to the narrative argument you're making, so that SIU is also, you know, policy entrepreneurship and a new story about how CMU should be EMU should be stabilized. So this is kind of the direction we want to go, and we're trying to make this clearer. And this basically then explains also the case selection, which we should maybe justify even further. But yeah, we'll go with the 2x2 table, and then this is already, I think, but this is indeed kind of the where we see that this how we can justify this, and then how we can really also provide a conceptual contribution to this. So it's not really saying, okay, this is the only existing infrastructure that is required for that, but really shifting the focus towards how household savings can be mobilized, and then saying, okay, these are crucial elements that are required for doing so. So I'm over time now. I'm sorry. Okay. Thank you.
Yeah, thanks so much for these comments. This is all very helpful. The advantage, of course, if we've seen your comments before, is that I have already thought a bit about how we're going to reply, because, well, because the point that that you make is in the sense of saying who are the actors. It's actually, for us, not really relevant whether the institutions are supranational or intergovernmental in terms of their governance when it comes to disbursements, because the funding departments always have quite a lot of autonomy. And I give you a very concrete example of that. In the 1980s, I think by now I've read all the board of director meetings of the EIB in the 1980s, because they're on the archives. Yeah, exactly. They don't speak about funding. Like, at some point, they just gave them an authorization, yeah, for the next year, raise this amount of money. They don't have a currency breakdown. So clearly, it's not the directors who tell the EIB funding department to increase the share of funding in ICU. And likewise, when we interviewed the people at the EIB about the climate awareness bond, it was the people in the funding department who came up with that. Like the person who is called the father of the green bond is a guy who was in the EIB hierarchy, who's now quite senior, but at the time he was just in the funding team. Right, so it's not necessarily that there can be cases. So the NGEU green bonds, that's something that was absolutely driven from the top by von der Leyen, that she said we want to issue green bonds in the name of the European Commission. But in other cases, can really just be that you have people in the funding department who are a bit entrepreneurial. And again, they see it as part of the organizational mission to do this. And again, we have... Yeah, yeah. 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 Okay. Okay. That's very helpful. No. No, but then the other thing is why we originally had it at the institutional level is obviously if we want to link it to the bigger phenomenon, not just say, yeah, they do that, but also it can have actually an effect, can actually have an effect that the market recognizes, oh, what the commission did there, set a benchmark for that market segment, right? And then that's why we have these dimensions of what makes these institutions unique and how we can link them to what they do and say, look, they can influence market outcomes because they're large and AAA rated. They can create new market segments because they are AAA rated and they have enough autonomy to be entrepreneurial. They can create European infrastructures in a way that no national debt management office can, because they are supranational in nature and they have a regional mandate, right? So there are things that distinguish these institutions that allow these technocrats to do these things that are inherent to the institutional standing and their position on capital markets. So that is how I respond to that point. I hope that, but again, we're still working on the reviews, but I hope that helps a bit on the mechanism. On the episodes, absolutely take the point. Yeah, the episodes are basically at this point anything that's interesting in the past 70 years of how the EU has borrowed, right? Or how European institutions have borrowed, because we looked at literally everything. And that is very illustrative and it's not very systemic. And I think that we can do a better job on this. And I think we'll have to discuss how we do that.
Thank you, Daniel. On point, very much spot on as always. So what is it that, it's not about the Bretton Woods, falling down and then, causing a lot of restructuring. And I'm not saying that it didn't cause, obviously it was a huge thing that caused some restructuring. But if we look at the offshore markets and before the Bretton Woods fall down, then the offshore markets already play a huge role. So basically, I mean, when the Bretton Woods in terms of the monetary infrastructure get operational, 58, right? And in 59, we already have the crisis. And then it's quite interesting to look into these central banks and what they were doing. They were just so desperate about trying to keep the fix. And then they operated on the offshore markets, Bundesbank, also all of the central banks, but Bundesbank specifically saying, oh, you banks shouldn't be going there, but then themselves supporting all the banks. So in a way, there was a lot going on that not only led to the fall down of the Bretton Woods, but also already caused a lot of tensions and problems and crucial significant impact on how European integration kind of forged and developed ahead. So it's not necessarily to say, this is all wrong, but definitely that wasn't. If we are to think about what are the pivotal moment in an IPE, we often go back, and political science as well, like, the Bretton Woods is the stability, the kind of, that's where government still regulated and these markets didn't have so much of a decisive influence. Whereas I think if we look to what happened on the Eurodollar markets and how that impacted these kinds of broader agreements and financial integration development, then they can't quite hold as the sort of key impetus that reshaped these places. Global currency view and radical historicism. Yeah, I didn't go into that in the presentation. It's basically an outcome where I was invited to contribute to dollar dominance, which then kind of, shaped into a global currency view theme. So I had to integrate that, and that's kind of part of where the tensions in the paper come from. I think where the global credit view, that's kind of a concept that's been coined by us as a special issue, but Mark Schwartz and Steffen Murer go into this more in depth, which kind of understands the monetary system as, it comes from sort of the money view, endogenous finance, where money isn't part of sovereign currencies created by central banks, but essentially part of it, it's bank credit. That is essentially what money is, and it flows around globally, via interlocking balance sheets. But yeah, it's a good point to work on that together a bit more specifically, because I think if we think about the money view, then we're losing a lot of the politics of how credit is actually made through the competition on these offshore dollars. There's a lot of politics involved that is not only present at the end of clearing, where reserves in the central bank shift sides or shift accounts from different banks to another, but there's a lot of credit creation that happens between banks as part of a competitive process on US dollar offshore markets. That's basically kind of my understanding of money and the politics involved. And well taken, I should get my historical nerdiness about banking practice and global finance a bit more into EU regulation and bring that out a bit more. You're right.
Great, thank you. Thank you for these fantastic comments. A lot to chew on. So I'll try to be quick here. So on the sort of use of transposition in the kind of EU legal context, that's me revealing my ignorance as a Canadian. I did not know that was a common term in the kind of specific EU parlance. So that's great. I will absolutely look that up and incorporate that because it certainly needs to be in there. Lucia, on your question on prepositioning being sort of more prescribed in the EU because the banks are more integrated. I mean, of course, this is the case, and the folks that I interviewed sort of made this point, right? Like, obviously, the banks are there's more foreign bank penetration, and as a result, there's sort of more push for this this deeper level of pre-positioning. But the concern of the folks at the Commission and the SRB and the resolution authorities that I spoke to was that this, in some ways, sort of legitimizes a subsidiarization approach and a kind of fragmentation of the EU banking system, right? That having these mechanisms that designate this pre-positioning, it is sort of antithetical in their view to the principle of the banking union, which is having pan-European banks where this type of pre-positioning wouldn't be necessary because these aren't national champions, they're European champions. And that by kind of creating these mechanisms to develop these insurance systems, they're embedding this process and kind of making it more difficult for those banks to kind of fully integrate, right? That they kind of there's more foreign bank penetration, but it's through subsidiaries and not branches. And they sort of view that as being maybe a barrier to kind of a full realization of the banking union. And then to sort of David and Lucas's question on the sort of fiscal components. So what I would say on that is that there's sort of a question of it coming backstops all the way down. And at what point, like where the actual kind of final break point is. So in the US, there's I believe it's called the Orderly Liquidation Authority, and there's equivalents in the UK and in Japan and in Canada, which is that there are, you know, at the first line of authority, there is like the FDIC, and there's kind of deposit insurance mechanisms, and then there's supplementary lending capacity, and there's lending capacity of the Federal Reserve. But at the very end of this chain, there's a clear legal mechanism for the FDIC to borrow directly from the Treasury. And that at the end of all of this process, if all of those prior mechanisms fail or they're not enough, there is a clear, unambiguous legal authority of the US government to step in and issue a bailout or finance a resolution through the Treasury. And the problem that was identified to me in these interviews is that for the SRF, yes, it is market funded, but that amount, so it's 81 billion, and in order to access that, there are rules to how much MREL you have to use before you can access that. That limits flexibility, but also there's a maximum amount of the SRF that you can use in any one resolution. It's 5% of the total liabilities of a bank, and so 5% of Deutsche Bank's total liabilities is about 81 billion euros, right? Which is to say that there's enough money in that pool to resolve one systemically important bank, assuming everything goes fine. So the worry is that in a systemic crisis, this is not sufficient. And during that systemic crisis, that market-based borrowing is likely to dry up. And maybe there's money in the ESM. Is that going to be enough? And it becomes this question of where does that money come from, if not from the member state governments? And so I think to your question, Lucas, like the way it was sort of framed to me was that, yes, the endpoint is in fact a fiscal union, and that it's difficult to, that there's a real risk or a sort of worry here that, that those mechanisms are not going to be sufficient, and that in the absence of a clear breakpoint and a clear legal authority at the end capable of lending an unlimited amount, that this might fall apart. And that was sort of how it was framed to me in the interviews. Yeah.
Thanks very much. Fantastic presentations. I have one quick question and very targeted, so I think it will be quick and efficient. So this is to Sebastian. I was curious to know if when you analyze those infrastructures, you would also consider the non-EU third country provision of those infrastructures, and here putting ourselves in the debate of, you know, independence, autonomy, strategic autonomy and the likes, etc., all those concepts that are in the policy making discourse. But somehow when I've seen those words of infrastructures, I thought, okay, well, how do we deal with that? So I don't know if it's part of your current research. I'm just curious to hear about it. Thanks.
Hello? Is it green?
Okay, yes, it is green. So it's just a comment for the paper by Lucas, and I think that it would be really helpful if you had some more on what this means in terms of a European safe asset and distinguishing from the Eurobond debate and how that fits in. And I had gone to an event at SEPS earlier this week, and I was on the Savings and Investment Union, and that was a big component of it. So I think that having, like beefing up its relevance for that or lack of relevance would be helpful.
My questions are for William. My first book was on bank resolution, so this is really my element. And to that end, I have one note on flexibility, which is be careful not to celebrate it too much. I think that a lot of people misread the fall of Lehman. The fall of Lehman wasn't the problem. The saving of Bear was the problem, because the US government used its flexibility to save Bear and break precedent, and that created a new precedent that Lehman would be saved. And when they restored the original sophisticated investor precedent, that's when markets went nuts. But the sin was saving Bear, not letting Lehman fail. And to that end, obviously you've spoken to US policymakers, but when I spoke to FDIC policymakers, they were very clear that they thought their strict resolution mechanism was the key to their success. And that's how they managed to save giant banks like Washington Mutual or resolve rather, large banks like Washington Mutual. So flexibility can be a problem if it skews market expectations. Although to that end, one note that I always think of when people talk about European deposit insurance is, off the top of my head, I don't remember who said it, but I believe it was a German in the finance ministry. Every country has deposit insurance. Some just don't know it yet. It might have been.
We wouldn't subscribe to that one.
Now it's working. Yeah, three very short questions. Two for Lucas and David. A conceptual one. Use the term concept of market making in reference to the supranational actors. That issuance, I was in terms of creating markets, but usually of course they're an expert in market making, market shaping categories, and this concept is more linked to the kind of creation of autonomous capacity and empowering of market actors against state intervention. So I was wondering if maybe a concept more linked, as you also quote Brown's infrastructure dependence in terms of how to build a sovereign capacity through the markets, but in a way steering and shaping the markets more than creating an autonomous empowerment space for market actors will be much more useful and clear in your conceptual framework. And other point about the issue of competition with sovereign bonds, unleashed in a way, open up with the issue of supranational bond issuance. You also focus on that, in terms of the debate, in terms of the possible conflicts and with and the pressures put on national sovereign bond issuance due to the entrepreneurial character of supranational actors in this field. And a short point on Mariki papers. I haven't read the papers, but I will do it because it's super interesting. And as far as I understood, you didn't focus on the SIU properly, in the later stage, but would be interesting to, I was wondering if you also look at the different ways the kind of US dollar hegemony change in terms of the main market actors also supporting them, because an interesting development is an increasing role in the last 10, 20 years of big US asset managers are one of the main actors and channels of this enduring and changing US dollar hegemony. So I was wondering if you also consider the changing, in critical IP terms, capital fractions underpinning this US dollar hegemony. Thank you.
I will be
Very quick. Just very quickly, one question to David and Lucas. For me, it sounds somehow, maybe it might be the German negativity, but it sounds like a very smooth story. So everything was very like, agreeable and so on. So I was wondering if there was any conflict or friction, because it's like, it seems like a very, very big deal, no? But you haven't really talked about any backlash, for example, from the Germans, no? Or whoever. And I think I would like to see a bit more of that. And similarly, Sebastian, at the very end, you mentioned that like this is still a very important political economy topic, and that there's a lot of actors competing. But I don't know if I maybe have overheard it, but I was wondering who's competing over what. And then if you compare the digital fix to the financial fix, if you see similarities in the actor constellations that are actually fighting over like a certain dominance or gold plating or whatever. Thank you.
All right, so we have a quick round of replies. Lucas can start, and every minute you take is going away from the coffee break, so.
Okay, it's putting me under a lot of pressure. So I'll bundle up the two questions on the safe asset and sovereign green bonds, on the sovereign bonds, because it's actually quite simple. The ESM is pricing only behind Germany and the Netherlands and Luxembourg at this point. The EIB is slightly above that. The Commission is still pricing better than France, but there are a couple of member states that are better than the Commission. So they're not exactly at the same yield, but they're all not doing super well for AAA rated issuers. The reason for that is because they're in a different market segment than the sovereigns. They're in the supranational, subnational agency, SSA segment, which means that they're not included in the indices, which means that bank treasuries, if they want to buy sovereign bond indices, can't necessarily buy them. Commission is fighting tooth and nail to get into these indices. They're currently not there. So this is one discussion. Whenever they pitch themselves as safe assets, in financial terms, they are, but their liquidity and their market standing is not exactly equivalent, which means that currently central banks like to buy the Commission because it's the best yielding AAA bond you get anywhere. So this is what I can say about this, and I think this also helps a bit on the issue of competition with sovereign bonds. On the issue with market creation, yeah, it's a matter of terminology. Everybody has different terms for these intuitions. So we'll have to think about how to name it, and I'll go with that. And Vanessa, very quickly, oh yes, there's been German backlash. Oh yes. So we have one story. In 1988, the Commission issued a half a billion ECU bond, which was supposed to be the first benchmark for the ECU market. And that was a complete refinancing operation, which was not what the Commission was supposed to do. And a year later, the Council forbade the Commission from doing that. We have a paper in JCMS where we tell that story. So yes, absolutely. The Germans don't like the Commission to have too much autonomy in these things. But on the other things, on the EIB, that's, I think, a bit more tolerated because the EIB is not seen as competition to sovereigns.
Okay, yeah, thank you for these questions and comments. I'll be quick on foreign-owned infrastructures and if this is a problem, so foreign investment into that. I mean, let me respond but in conceptual terms. So, I mean, indeed, there's all this literature saying, well, there's geopolitical challenges, and that's why the EU is now changing its approach towards digital sovereignty or strategic autonomy. What we tried to do in this paper to take a different approach and come more from the internal structural dimension and saying, well, CMU lacks fiscal capacity, there's the financial fix for solving this, and now we're trying to argue there's even a financial fix for, which goes even one step further, which aims to include even household savings. So, to making more this structural argument, but indeed, this is an important debate, and there's lots of literature out there on digital infrastructures, for example, and the foreign investments. So, and particularly regarding, for example, the digital euro, I'm sure that this is a project also against US payment companies. So, but that's not what we wanted to focus on in this paper when we talk about the politics and the actors involved, which we need to flesh out much more. So that's true, yes. But yeah, there are new actors. So fintech becomes more important. They are sometimes in opposition to banks. Same goes for the central bank, the ECB. Then so there are new conflict lines, and this is what we're trying now to develop more in the paper. And then in the yeah. So that's indeed the empirical stuff we need to add. But I think there's new conflict lines emerging, which is important to analyze.
Thanks for the question, Giuseppe. It's a very good question because there's obviously changing agents within and how money gets made and circulated, and that keeps up US dollar hegemony. The banks are still really important because they are the makers of money. They generate the money. I do think that there's huge new agents. I'm interested in private equity as asset managers, which I think, so I'm interested in innovations and the dynamism that is kind of generating new ways and how that's kind of impacted financialization. I think they've been pioneering like leverage and all these kind of, you know, abilities to just attract a lot of money, even though you don't have much. And I think that's one of the, you know, most amazing, if problematic kind of techniques and innovations that allow you to just, you know, make more money out of very little. And I think what's interesting in terms of Europe is how they're now buying up lots of, you know, housing. And so I think that's actually, and I have no idea, but I'd be curious how that relates to the SIU as a, because what I find interesting, not necessarily how, that's also interesting, how household saving is kind of channeled, but more importantly, how housing assets are kind of integrated into global markets. And I think that's where, but that's, you know, that's my research plans in future, and, you know, happy to discuss more.
Okay, great. So I'll be very brief since I'm between this and coffee. So I will just say, just on the FDIC. So yeah, I mean, this is the model for the rest of the world, really, in this space. Like, the global standards were really like an attempt to kind of diffuse existing FDIC practices to the kind of global system. And in fact, when you read European Commission proposals for the resolution, they explicitly reference the FDIC, right? I don't remember if this made it into the final paper, but I had a quote at one point that basically was from the Commission document that said, these reforms will bring us closer to the model of the FDIC, right? So that's what the Commission at least is looking for. And the reason for this is not necessarily the stringency of FDIC rules, but the fact that they have a variety of broad discretionary powers. So to get a little bit technical, they can pursue an open bank bail-in, a closed bank bail-in, a partial bail-in, a bridge and transfer strategy, a standard liquidation, or some Frankensteinian combination of all of those things. And they have broad discretion on the circumstances in which they choose to do that. And the difference is that the SRB has a much narrower range of tools. It's pretty much only an open bank bail-in, which a lot of people think is maybe the least likely to be successful. And the conditions in which they can do that are circumscribed, right? They have to bail in a certain amount of MREL, and there's a whole set of conditions that need to be met for these strategies to occur. And so this is sort of the, this is viewed as one of the sort of key barriers, right? Is that without the sort of broad discretionary authority to choose how to intervene, and without the legal authority to, and the kind of broad suite of powers, that you might be left with tools that don't work in the particular circumstance that you might be faced with.
Okay. Yes. All right. Thank you, everyone, for coming back for the thrilling conclusion of our event. So the final panel will be regulatory politics and financial market integration. So we have a mix of people in the room as well as online. For technical reasons, we will start with the person in the room, that is Giuseppe Montalbano, and he is going to be presenting Playing the Market's Fragmentation, Regulatory Competition and Financial Industry Interests in the Missing Supranational Supervision of European Capital Markets. So I will signal to you at minute 12, and so we're aiming for 15.
I told you about this.
Sorry. Okay, thank you. Oh, thank you. Okay, thank you. So some people still missing. So Good morning, everybody. Happy today to share with you a present very, very preliminary draft of this paper I'm working on, which is essential in the role of financial industry interest and influence in the missing, lacking supranational supervision of European capital markets, and trying to focus on the concept of regulatory competition and trying to understand how and for what conditions. I mean, one of the supposed main beneficiaries of a capital markets integration, integrated supervision, like cross-border market incumbents, are at the same time or could be the one blocking, opposing such supranationalization of supervision. Yesterday we yesterday we already had a fantastic afternoon panel on financial market supervision and integration in EU. So I'll be very, very short on this, just to remind you that the issue of capital market supervision been a long-standing debate accompanying the construction of a single market in financial services since the Financial Services Action Plan about 26 years ago. One of the main cleavage in this discussion in the last 26 years has been between a model of supervisory convergence based on national competent authorities, so mostly based on an intergovernmental or transgovernmental system, against a more direct supranational centralized EU-level direct supervision, so implying a major institutional overall transferring supervisory powers from the national level to the EU one. This accompanied the debate on the transformation from the former Lamfalussy level 3 committees to the European supervisory authorities in the wake of a global financial crisis and the construction of ESMA. Which, as yesterday we reminded, was the first authority, the first agency being granted with direct supervisory powers related to credit rating agencies and then trade repositories. And then for since the question of direct supervision then resurfaced from the banking union, the creation of a single supervisory mechanism, and then the following CMU agenda starting from 2015, and particularly after the Brexit question. But what is interesting is that this, compared to the very first years of ESMA, the debate on ESMA and the process of empowering and enhancing, expanding ESMA's capacity has been quite gradual, incremental, without major institutional changes. Here, just a timeline about the different competencies and areas where ESMA's direct supervision powers expanded from 2011 to 2025. What is interesting, the two major points, it's birthed with the supervision of credit rating agencies, and then a few years later, trade repositories, and then in the context of the ESA's review in 2017, 2019, the acquired prerogatives of some critical actors, in particular the most important one we will see in a while, central counterparties, but the third country and systemic central counterparties, the securitization repositories, administrators of critical benchmarks, and data reporting services providers. And then from, I would say that from 2024, from the publication of the different reports, the Noyer, Letta, and Draghi's reports, the question of single market, single financial market supervisor came back to the political agenda of the EU, being framed as a kind of priority issue, as a needed pillar to relaunch capital markets integration. And sparking again divisions and debate, even particularly, I mean, strong debates within the European Council in some critical European Council meetings preparing the future agenda of the SIU. What is interesting is that the Commission, again, building particular on the Draghi's report, put in the SIU strategy and communication in March 2025, the strengthening of direct supervision of critical market actors, in particular trading, post-trading, market infrastructures, and asset management companies as a main priority issue in the SIU action plan. And on the other side, in the recent market integration package in December 2025, is interesting that the formal proposal of the Commission foresee a direct supervision of market infrastructure, cross-border systemic market infrastructures, but not for the asset management industry. And from this, the two main research questions I would like to address in this paper is, first of all, trying to explain the failed attempts to transfer direct supervisory powers in these two critical fields for these two financial industry segments, market infrastructure and asset management, from the CMU agenda to the SIU. And in particular, then try to explain the recent developments coming from the December 2025 market integration package. These different outcomes, very interesting, and specifically why the Commission proposals in the end advance the centralized supervision of trading and post-trading systematic market infrastructures while leaving asset management companies under a national-based supervisory convergence style. Here, the main argument I like to develop is that we should look at the role of transnational corporate actors, transnational financial industry actors in general, the role of transnational corporate power to account for such different developments and patterns of ESMA's direct supervisory prerogatives, and focusing in particular from both at the level of agency and the structural capacity of these actors from the agency side, so looking at the strategic interest and their calculus of competitive advantages and disadvantages in furthering supranational supervision, the capacity of these actors to construct, to build lobbying coalitions and to influence EU policy and from, of course, trying to exploit in different national and supranational venues, influencing the critical EU policymakers, but not just looking, as most of this literature on lobbying actually do, the agency side. Also, my attempt is also to focus on the kind of structural interdependence, I would say, these actors create with critical financial centers at the European level. It's interesting here to stress that, I mean, the financial geography of these critical financial centers is not necessarily overlapping with the classical geoeconomic intergovernmental map of state powers in the EU. As I would like to show is that the continuities and changes in the patterns of structural interdependence among these cross-border actors and these European financial centers, which are, as we'll see, also the one, I mean, based in the small states like Ireland and Luxembourg, play a crucial role in shaping the different patterns of supervisory supranationalization. A short look at methodology. Essentially, I will combine congruence and process tracing analysis. That means, I mean, try to derive from the main argument of competing explanations some specific empirical expectations that then I'll verify with an in-depth process tracing analysis of two cases, then evaluating, I mean, the pieces of evidence to see what is the argument and approach that works better to explain our outcomes. In terms of case selection, I'll focus on the asset management and market infrastructures as the as two areas which have been targeted by past unsuccessful initiative in supervisory supranationalization, which are also, from the point of view of the Commission, the EU policymakers, the key market segments to enhance, I mean, to target in order to enhance ESMA's power. And in terms of different cases, I will look at two critical moments: the ESA review in 2017, and then the making of a SIU agenda in 2024, also looking at the different outcomes in these two cases. And just a short look at the sources, I mean, mostly using a qualitative content analysis approach, and looking at all the responses to 5 relevant stakeholders consultations, systematic review over the debates over ESMA's reforms in different news outlets at the European level, and then also on the process of realizing semi-structured interviews with key stakeholders. I planned 20 interviews. Now I managed to realize just 4 because apparently nobody wants to speak, on financial supervision. I don't know why. It's quite a sensitive topic, but still struggling to get more interviews on that. I'm quite confident I'll be successful, I hope so. So going to the main arguments and expectations according to our congruence approach, from an intergovernmentalist domestic center approach, we can assume the core member states are the critical players, and the preference of these core member states will be shaped by critical domestic players in order to protect their competitive position. At the same time, according to this perspective, we should look at the structure of domestic financial banking system to predict the different positions of member states. In terms of our expectation, we will expect that ESMA's empowerment will depend on the interest of powerful member states, first of all, Germany, France, and until Brexit, the UK, which will be in turn allied with demand of the domestic financial industry. Supranationalism. Yeah, okay, I'm already going, my God. I'm going very fast. According to supranational perspective, we have to look at functional pressures, the role of supranational entrepreneurs and cross-border actors who are more or less aligned with the supranational actors. We will expect then the Commission to play a critical role and key supranational cross-border actors aligning with the Commission and ECB push for more integration and more centralized supervision. And then lastly, from a transnational corporate power perspective, we will assume cross-border market incumbents to strategically exploit multiple lobbying venues, and also the changing pattern of interdependence with critical financial centers, exploiting in different ways, the advantages of a more supranational integration or national-based regulatory competition and arbitrage. And so from this point of view, we will expect that ESMA different patterns of empowerment will depend on the market incumbents' strategic orientation, the cohesiveness of the group at European level, and the patterns of interdependence with European financial centers. Shortly, I will spare all the empirical details about our empirical story, just to evaluate the different arguments against our evidence in the process tracing analysis. From an intergovernmental perspective, the case of asset management is quite tricky to explain, because I noticed a disjunction between the position of core member states like France and Germany and the demands of their national cross-border champions. And also this intergovernmental perspective would hardly account for the apparent influent role of small member states like Luxembourg and Ireland in watering down ESMA's direct supervision. In terms of supranationalism, the case of asset management is even harder to explain, because the Commission, ESMA and ECB have been substantially defeated, both in 2017 and 2025, because they initially supported and favored the supervision, the direct supervision of these actors, and they failed in promoting that. Also, from a functionalist perspective, we will expect Brexit, to have provided a kind of a crisis-led functional pressures, frictions, and to promote this supranationalization, why it did not occur at all. While from a transnational perspective, we found a large degree of cross-border actors cohesion, consistent, prolonged, intensive lobbying efforts, exploiting variable alliances with national and supranational actors, and most importantly, we could explain the successful case of asset managers who managed to defy, the proposal for supranational supervision in terms of the critical interdependence of the European asset management industry from the polycentric network of financial centers, particularly based in UK, Luxembourg, and Ireland as venues for domiciling these funds. Since the structure and the geography of asset management in EU depends on this polycentric system, we can explain, why in the end it failed. Already run out of time, just to say that for market infrastructures is much more complicated, our picture, because actually from an intergovernmental perspective, Germany's opposition to centralized supervision and its changing stance in 2025 would explain why, will contribute to explain why in the December market integration package, it advanced this proposal. But still there is a misalignment between member states' positions and their domestic champions. Again, supranationalism fell short, in providing a convincing explanation, particularly for the 2017 case. And then I conclude, I promise, from a transnational perspective, we would better understand, also complementing an intergovernmental explanation, why particularly in particular Germany, I missed this one, sorry, why Germany changed its position from 2017 to 2025, because it was a long-standing opponent of a centralization supervision for CCPs. Then in 2024, 2025, it came to support it, aligning with France, and we will explain that thanks to the strategic reorientation after Brexit of core market incumbents, a group of stock exchanges and CCPs like Euronext and Deutsche Börse. And I conclude, I run out of time. I'm open to questions. Thank you.
Thank you. Okay, so next up we have Hugh McCartney, U.S. Asset Managers and the Restructuring of European Banking, Competition, Consolidation, and the Savings and Investment Union.
Thank you, Michelle. Shall I screen share from here, or do you want to do slides from there?
Yes, you should use. Yep, we got it. It's coming on something. Yes, you got it.
Got it. Is that clear on there? I can't see you anymore. WebEx is.
Yes, it's wonderful.
Okay, good. All right, we'll jump straight in. So I have 3 apologies to start with. Firstly, sorry I can't be there in person. Secondly, probably more, proactive for the paper. I had a period of ill health at the end of last year, so we started this paper quite late in the day. Michael and I started working it about a month ago. And my third apology is that I'm slightly out of the loop with what's been happening in European Capital Markets Union and things over the last few years. Most of the work I've done recently has been on America and the UK. But Mikhail's obviously, I'm sure he's told you over the last day or two, he's been working on this stuff for the last couple of years with his PhD. And I think part of the reason David asked me to write on the asset management thing is we've been doing some work on money market funds and asset managers in the US for the last couple of years as well. So I think the big claim we're trying to make with the paper, I've kept it to one slide really with a silly little graph on the next page to keep it pretty simple. I wasn't sure if the WebEx was going to work for us today. I think the big claim we're trying to make essentially is that there are many ways, as we've seen over the last day, to view the SIU, but we want to make this argument that it's essentially this clash of countervailing forces on the, we're slightly provocative maybe in the paper, this invasion of US asset managers into Europe, and then in particular, probably empirically for our paper, will be the EU bank defensive responses. So that's essentially our big claim that we're trying to make with the paper. Theoretically, we're still, toying with a few different ideas. I think probably what's stood out to us both over the last month or so is that there's probably an argument to be made about some kind of economic patriotism here and the idea of fortress Europe. That probably gives us a way into this. But as you'll see if you read through the draft of the paper, we're also toying with this idea, certainly in the theory section, of using something to do with infrastructural power as well. It's definitely not fleshed out in the analysis at the moment. I think what struck me when we started working on this is that, and I was thinking back to work I'd done in the 2000s and things, and my PhD project, early 2000s. And the story that I remember kind of trying to make then, and others were, Daniel Muger and others were telling a similar story, the 1990s and 2000s, and I think it contributed to David's work as well on market-based banking. It was the US banks essentially entering Europe and offering these kind of cheaper investment products and the kind of capital markets-based system, leading to some extent to a breakdown of the credit-based system. But I think when we started looking at what's happening in Europe now, it seems to Mikhail and I that there's something maybe substantively different going on. That plus something else, that it's now a case, perhaps, and this is still to be worked out, it's more of a hypothesis at the moment, because US asset managers obviously seem to play quite an important systemic role in things like EU repo markets and provision of things like Aladdin to European financial actors as well. So it's not just that they're providing these cheaper services and products, it's also now that they're kind of woven into the very fabric of financial infrastructure in an open market operations of ECB and various other things in Europe. So I guess the question that we have regarding infrastructural power at this stage, and I'm open to any thoughts you have on this, is, does that give these US asset managers a different kind of power as we think about this kind of question of SIU? So we then have this section, point 3 on the slide there, about European asset management. And there's one, this is particularly what Mikhail's PhD is about. There's one key point that we are pains to emphasize there. It's that there is something probably substantively different how asset management is organized in Europe versus, in other places like North America, where there are obviously big banks, JP Morgan in particular, that still have both, kind of traditional banking operations and asset management divisions, but we're also thinking of the big firms, BlackRock, Vanguard, et cetera, that, they're not traditional kind of banks, whereas in Europe, most of the biggest asset managers tend to be, asset management divisions tend to be within the big banks or spill-offs of the big banks themselves. So that's part of the story we want to tell in that section. The second part of the analysis, the US invasion, then looks at the growth of US asset managers. And obviously, this one of the things that I found very interesting in the paper that we've sent a couple of minutes ago, we've been trying to get this paper over the line for the last last year, to be honest, on US money market funds. One of the stories we tried to tell in that paper was how the biggest Wall Street banks, basically, as they saw these massive outflows of deposits from their traditional kind of banking operations to higher yielding things like money market funds, etc., was how the biggest American banks then restructured their operations to try to keep those, departing deposits in-house, as it were. And I think this is a little bit, again, of a hypothesis and a question we have. We haven't got this fleshed out in the paper at the moment. But, obviously the US asset managers, as they enter Europe, are offering cheaper products, index funds, etc. But it's also the scale of their US operations that gives them this kind of cost basis, I suppose, to be able to work pretty efficiently in Europe. The main crux of our paper then will be this European responses. And, it's not in the paper at the moment. It only occurred to me yesterday as I was thinking about the presentation now. But I wonder if there's a parallel dynamic at work in Europe as to what we've seen with the money market funds and the big American banks. So probably a new section. Again, this is the first time Mikhail's hearing about this. So Mikhail, here we go. Here's a third section I think we should probably add in. But I'd be interested to see the extent to which the biggest European banks are actually responding by, expanding their range of in-house products. That would probably be a new first section to the paper, to the European responses section. The second one that is in the current draft has to do with consolidation and European banks trying to develop scale by mergers, acquisitions, etc. And we've only dipped our toes in the water really with the third bit, which is this kind of engagement of the European banks with the SIU project. There are 3 themes that seem to come out for us from the consultation responses so far. One, this attempt to kind of promote European champions, which I think links back to our question about economic patriotism. The second one we found very interesting was to do with a kind of investment geography, something that obviously come up in the Noyer paper before, this kind of minimum criteria of trying to make sure that investments had this kind of, I think it was 80% criteria investing in Europe, etc. and the big American banks and the ICI, the Investment Company Institute, strongly resisting that, kind of saying that it would be much better to allow investors and to have the investment products that are global in scale rather than just simply European. So the question of investment geography there. And the third one had to do with inducements and the structure of fees. And it was interesting, Mikkel and I were kind of going back and forth about this a little bit a couple of weeks ago. It would seem to be a very big theme in about 2021, 2022. The Commission took a position on it then on being lobbied by the big European banks, went back on that, allowed Europe to operate with these two different kind of structures of fees and inducements, etc. The Americans took quite a strong position against that. The Commission stood its ground and the Parliament pushed that through. I think Mikkel will give us the date, I think it was 2023. But it seems like when we looked at the recent consultation responses, the Americans, it doesn't come up at all in the European responses, but it does for the Americans. It's back on the agenda for them as a very highly uncompetitive, anti-competitive practice. So in short, to kind of summarize very, very quickly, I would say our one goal, I suppose, is to try to push the argument a little bit further that SIU shouldn't be seen simply as this technocratic project, but as some kind of political economic struggle between two competing financial models to an extent. One, in one sense, that's simply a battle for access to EU savings, but also perhaps, and this is again to be a thought in progress, I suppose, is there some kind of attempt to maintain or engage or expand control over Europe's financial infrastructure as well? That's my time.